In 1971, I worked as a clerk on the floor of the New York Stock Exchange. To understand what happened that year, it's crucial to grasp how money functioned at the time. Since World War II, the Bretton Woods system had been in place, where the U.S. dollar was backed by gold at a fixed price of $35 per ounce. Other countries pegged their currencies to the dollar, creating a stable international monetary system. On August 15, 1971, President Richard Nixon appeared on television on a Sunday night and made a historic announcement. The U.S. would abandon this system and no longer allow other countries or citizens to exchange their dollar for gold at that fixed price. This event became known as the Nixon Shock. Nixon cited international imbalances and the need to protect the dollar, but the real reason was simpler. The U.S. no longer had enough gold to back all the dollars in circulation. Fort Knox's reserves were dwindling rapidly because other countries, especially France, were redeeming large amounts of dollars for physical gold. The next day, I arrived at work expecting panic. The foundation of our monetary system had fundamentally changed, leaving the dollar as mere paper backed only by trust in the government. Logically, I anticipated the stock market would plummet amid this uncertainty. To my surprise, the opposite occurred. The market surged dramatically, posting one of its largest gains in years. This contradictory reaction baffled me so deeply that I began researching similar historical events. I discovered a fascinating parallel. On March 15, 1933, nearly 4 decades earlier, President Roosevelt had made a similar move by banning U.S. citizens from owning gold and devaluing the dollar. Both measures sought monetary flexibility during profound economic crises. Studying these events, I grasped a fundamental economic principle. Abandoning a gold standard or devaluing a currency initially allows printing more money to stimulate the economy. Markets often respond positively in the short term due to increased liquidity. Assets like stocks, real estate, and commodities rise in price not necessarily because they're worth more, but because money becomes worth less. This lesson helped me identify patterns in economic cycles that many contemporaries overlooked. I realized events that seemed unique in my lifetime often had historical precedents with predictable outcomes. I intensely studied the Great Depression, policy responses, and their consequences, which gave me invaluable perspective. This knowledge later enabled me to anticipate the 2008 global financial crisis. I saw how near-zero interest rates constrained the Federal Reserve's traditional tools, mirroring the 1930s. I correctly predicted the next step would be quantitative easing, essentially printing money to buy bonds. Undoubtedly, this mirrored monetary responses from earlier periods. The most important lesson I learned is that understanding economic history provides a significant edge in navigating modern markets. Monetary and debt cycles follow recognizable patterns that, while manifesting slightly differently, maintain constant underlying principles. When facing a severe debt crisis, traditional economic tools eventually hit their limits. In a normal recession, the Federal Reserve can stimulate the economy by cutting rates to make borrowing cheaper and reignite growth. However, a fundamental problem arises. Interest rates cannot fall significantly below zero. Once they hit that lower bound, central banks lose their primary tool, as occurred during the Great Depression in 1933. Studying that era, I found that when rates can't drop further, governments resort to printing money to buy government bonds directly. Modern economists call this quantitative easing, but the basic mechanism mirrors the 1930s. When the 2008 financial crisis erupted, I watched the same pattern unfold. Rates slashed to near zero, with a stagnant economy. Then, as I expected, the Federal Reserve began printing trillions to buy government bonds, repeating historical tactics. This knowledge fundamentally transformed my approach to analyzing economic events. Instead of relying solely on modern models, I began systematically studying historical periods to identify recurring patterns. We are now at a critical inflection point in the global economy. Most understand short-term cycles 5 to 10 years, but few grasp the larger debt cycle occurring every 75 to 100 years. We stand on the brink of such a cycle, akin to those of the 1930s and 1780s. During these events, we witness massive debt restructurings, currency devaluations, and fundamental shifts in international monetary systems. One person's debts are another's financial assets. When debts grow too large without sufficient productivity, the credit system, like a circulatory system, clogs like accumulated cholesterol. The U.S. government has an annual interest bill of approximately $1 trillion. This year, it must refinance over $9 trillion of debt, creating an imbalance between bond supply and demand. Central banks eventually intervene by printing money to compensate, devaluing the currency. We saw this dynamic in 2020 to 2021 with pandemic stimulus, where inflation acted as a warning heart attack. In this scenario, I expect rate hikes combined with broad currency depreciation. Historically, assets like gold and Bitcoin emerge as alternative stores of value amid weakened fiat currencies. The key investment strategy is diversification, allocating around 15% to safe haven assets. It's critical to avoid overexposure to assets inflated by recent momentum, balancing portfolios between depressive and stimulative moves. When traditional tools fail, governments often blend debt restructurings with monetization. This could include extending maturities or even disguise selected defaults, akin to 1930s policies. Ultimately, recognizing these historical patterns allows anticipating policy responses and safeguarding wealth. As in the 1970s, all fiat currencies may depreciate in tandem, making it vital to hold assets outside the traditional monetary system.